Welcome back to Nestlé's Financial Analysis series. If this is your first time watching, I highly recommend you starting with the part 1. Each episode builds on the previous one, so watching them in order will make much more sense and will give you the full picture. Nestlé pays billions in dividends and share buybacks every year. But where does all that cash actually come from? Because financing strategy doesn't start with that. It starts with cash generation. Nestlé consistently generates massive amount of cash from its core business. So before we look at Nestlé's debt or capital structure, we need to understand one fundamental thing: how the company generates and uses its cash. In this section, we will break down 3 key elements of Nestlé's financing strategy: how much cash the business generates, how this cash is allocated between investment, shareholders and debt, and how this ultimately shapes Nestlé's capital structure. Let's start with one of the most important indicators of financial strength: operating cash flow, the cash generated directly from Nestlé's core business activity. In this chart, we see the trend of both operating cash flow and free cash flow. So let's start by focusing on the operating cash flow trend. As we can see in the trend, Nestlé consistently generates a strong level of operating cash flow, generally in the range of 14 to 15 billion. However, the trend also reveals an interesting pattern. From 2019 to 2022, operating cash flow gradually declined. In 2019, Nestlé generated about 15.8 billion. But this figure decreased over the following years, reaching its lowest point in 2022 at around 11.9 billion. But the story doesn't end there. Starting in 2023, we see a clear recovery. Operating cash flow improves significantly, and by 2024, Nestlé reaches nearly 16.7 billion, marking one of the strongest levels in the period. This shows that Nestlé quickly regained its strong cash generation after the decline, which is essential for supporting its financing strategy. But generating cash is only part of the story. The real question is how much of this cash remains after the company reinvests in its business. This is where free cash flow becomes really important. Free cash flow represents the cash remaining after capital expenditures, the investments required to maintain and grow the business. This is the cash that can be used for acquisitions, dividends, debt reduction, or share buybacks. And in this chart, we are using the free cash flow as reported by the company. If we look at the trend, free cash flow follows a very similar pattern to operating cash flow. In 2019, Nestlé generated around 11.9 billion in free cash flow. But over the following years, we see a decline, reaching its lowest level in 2022 at around 6.5 billion. Then, just like operating cash flow, the situation improves again in 2023 and 2024 as Nestlé restores stronger cash generation. But now comes the really interesting part. Once Nestlé generates this cash, how does the company actually allocate it? Before we continue with the analysis, a quick look behind the dashboard. All financial data comes directly from the company's official annual reports and investor relations publications. Historical share price data and market information are integrated from trusted financial sources such as Yahoo Finance and Investing.com. Exchange rates and supporting financial datasets are also incorporated into the model. Using these verified sources, I built a standardized Power BI data model that automatically transforms raw financial information into interactive financial reporting and analysis. This dashboard is the result of that process. At the top, we have a breakdown of cash outflows showing how Nestlé allocates its cash between capital expenditure, acquisitions, debt repayment, and shareholders' return. And at the bottom, the waterfall chart brings everything together, showing how each cash flow moves from operating cash flow all the way to the final change in cash. And one thing immediately stands out. A significant portion of Nestlé's cash is consistently allocated to dividends and share buybacks, highlighting a strong shareholder-focused strategy. If we look at 2018, Nestlé generated about 10.8 billion of free cash flow. More than this cash amount, around 14 billion is distributed to shareholders through dividends and share buybacks. In addition, 2018 also included a major strategic investment, around 9.5 billion for Nestlé Starbucks Global Coffee Alliance, which we discussed in the previous video. At the same time, Nestlé also reduced financial risk by repaying 2.7 billion of debt. Now let's move to 2019. Here we see around 12 billion in free cash flow, while Nestlé distributed more than 17 billion to shareholders, including 9.7 billion in share buybacks and 7.6 billion in dividends. And this raises an important question. If Nestlé generated 12 billion in free cash flow, but distributed more than 17 billion, where did the extra cash come from? Did the company rely more on debt? Did this increase its financial risk? We will answer that in the next section. But even here, the waterfall gives us a first clue. In that same year, Nestlé recorded a strong cash inflow from business disposals, around 9.2 billion, providing an additional source of cash beyond its free cash flow. Let's look at 2022, which was the weakest year for free cash flow in this period, at around 6.5 billion. Even in this challenging year, Nestlé still distributed roughly 18 billion to shareholders. At the same time, the company repaid around 3.2 billion of debt and made additional acquisition of about 1.7 billion. In other words, even when cash generation weakened, Nestlé maintained its shareholder return strategy. Finally, in 2023 and 2024, as operating cash flow and free cash flow recovered, Nestlé continued this approach. In 2023, around 14 billion was returned to shareholders, while the company repaid approximately 3.5 billion of debt. And if we go to 2024, with around 10.6 billion in free cash flow, Nestlé again allocated more than 50% of cash to dividends and share buyback, while also reducing debt by around 5 billion, further lowering financial risk. So overall, one thing becomes very clear. Nestlé follows a very consistent financial strategy. The company prioritizes returning cash to shareholders every year, even during periods when free cash flow temporarily declines. But this leads to the key question for our financing analysis. If Nestlé sometimes distributes more cash than it generates, how is this strategy financed? Does the company rely heavily on debt? And what impact does this have on its financial risk and leverage? But before moving to leverage ratios, let's take a closer look at how Nestlé actively manages its debt through cash flows. This chart shows debt inflows and debt repayments over time. In other words, how much debt the company raises versus how much it pays back. What we can see is that starting from 2020, Nestlé significantly increased its debt inflow, rising from relatively low levels to around 10 billion per year, and then fluctuating around that level in the following years. At the same time, the company continues to repay debt consistently, with outflows generally between 3 and 5 billion, reaching around 5 billion in 2024. So in practice, Nestlé is not simply accumulating debt, instead it is actively refinancing and adjusting its debt position, raising new debt while also repaying existing obligations. For example, in 2024, Nestlé raised around 8 billion of debt while repaying about 5 billion, resulting in a net increase. This dynamic reflects a controlled and strategic approach to debt management rather than uncontrolled leverage growth. Now that we understand how Nestlé manages its debt flows, let's look at how this translates into its overall capital structure and leverage. To do that, we will analyze Nestlé's debt, equity evolution, and gearing ratio. To better understand how Nestlé finances its strategy, we first need to look at how efficiently the company converts its earnings into real cash. This brings us to the cash conversion ratio. This indicator measures how efficiently EBITDA is transformed into operating cash flow. In other words, it tells us how much of Nestlé's accounting earnings actually becomes cash that the company can use. Before looking at the trend, let's quickly review how this ratio is calculated. The cash conversion ratio compares operating cash flow to accounting profit, EBIT or net income. It shows how effectively the company transforms its profit into real cash, a key test of earnings quality and financial discipline. It answers, does the company actually collect the cash behind its reported profit? So, cash conversion ratio equals operating cash flow divided by EBIT. Now that we are back, let's look at the evolution of Nestlé's cash conversion. Overall, Nestlé demonstrates very strong cash conversion, with the ratio generally staying well above 80%. This means that a large share of the company's operating earnings is successfully converted into real cash flow. The ratio even reaches above 90% in 2019, highlighting particularly strong cash generation during that year. However, we see a noticeable decline in 2022, where the ratio falls to around 71%. This reflects the period where operating cash flow weakened, which we already observed in the previous page. But this decline appears to be temporary. In 2023 and 2024, the ratio improves again significantly, returning to levels close to 90%. Which indicates that Nestlé quickly restored its ability to convert earnings into cash. Overall, this trend confirms that Nestlé maintains a very efficient cash generation model, which is a key foundation for its financing strategy and its ability to consistently return cash to shareholders. But generating operating cash flow is only one part of the picture. The next question is how much of this cash actually remains after investing in the business. To answer that, let's look at free cash flow margin. While operating cash flow shows how much cash the business generates, free cash flow margin tells us how much of Nestlé's revenue ultimately turns into cash that the company can actually use. In this chart, we can see the full bridge: operating cash flow, capital expenditures, and the resulting free cash flow, together with the free cash flow margin as a percentage of sales. And the trend here reflects the same pattern as observed earlier. In 2019, Nestlé generated a free cash flow margin of around 13%. Meaning that for every 100 francs for revenue, about 13 francs were converted into free cash flow. However, over the following years, the margin gradually declined, reaching its lowest point in 2022 at around 7% of sales. This reflects the same period where operating cash flow weakened and investments absorbed a larger share of cash generation. But once again, this appears to be a temporary phase. As Nestlé's operating cash flow recovered, the free cash flow margin also improved, reaching about 11.2% in 2023 and increasing slightly further to around 11.7% in 2024. Overall, this confirms that Nestlé maintains a strong capacity to generate free cash relative to its sales, which supports its long-term strategy of investing in growth while consistently returning cash to shareholders. Now that we have looked at cash generation and free cash flow efficiency, the next step is to understand how this translates into Nestlé's capital structure. In this chart, we can see the evolution of net debt and total equity over the period. And the trend here is quite striking. Nestlé's total equity has been steadily declining throughout the period. In 2018, the company reported around 58.4 billion in total equity. But year after year, this figure gradually decreases, reaching about 36.7 billion in 2024. At the same time, we observe the opposite movement on the net debt side. Net debt has been increasing, rising from roughly 30 billion in 2018 to about 55.7 billion in 2024, which represents the highest level in the period. So together, these two trends create a very interesting picture. Equity decreasing while net debt increases. Naturally, this raises an important question. What is driving this evolution in Nestlé's capital structure? Why is equity shrinking while debt levels are rising? This dynamic is closely linked to Nestlé's capital allocation strategy, which we will explore in more detail on the next page. But before that, there is another key metric we need to examine. If debt is increasing while equity is declining, what does this mean for the company's financial leverage and potential financial risk? To answer that, let's look at Nestlé's gearing ratio. The gearing ratio shows how much of the company's capital comes from debt rather than equity. It indicates the company's financial risk and capacity to face downturns. In short, how dependent is the company on borrowed money to finance its operations and assets? Gearing ratio equals net debt divided by equity. Why it matters? It measures the balance between debt and equity financing. It indicates financial stability and risk appetite. High gearing means more leverage, higher potential returns, but also higher financial risk. Low gearing means more equity, safer, but less financial efficiency. Now let's take a close look at Nestlé's financial leverage through the gearing ratio. In this analysis, we compare two approaches: the standard gearing calculation and an adjusted version where we include provisions and long-term obligations like employee benefits to get a more conservative view of leverage. This comparison helps illustrate how accounting choices can impact leverage analysis. Let's start with standard calculation, gearing without provisions. Here we can clearly see a steady increase in leverage over the period. In 2018, the gearing ratio stood at around 0.52, but year after year this ratio gradually increases. By 2022, this surpasses 1, meaning that net debt becomes larger than total equity. The ratio continues rising further in 2023 and reaches its highest level in 2024 at around 1.52. Now, if we include provisions in the calculation, the leverage appears even higher. In this case, gearing increases from around 0.65 in 2018 to approximately 1.64 in 2024, reinforcing the same overall trend. Financial leverage has clearly increased over time. At first glance, this might suggest that Nestlé's financial risk is rising. But this is where we need to step back and think more carefully. Nestlé is not just any company, it is a very powerful cash-generating business. As we saw earlier, the company consistently produces strong operating cash flow and free cash flow. So the real question becomes, is higher leverage necessarily a problem for a company that generates such stable and predictable cash flows? In other words, is this truly an increase in financial risk, or simply a reflection of Nestlé's strategy of actively distributing cash to shareholders rather than accumulating excess capital on the balance sheet? To better answer that question, we need to go one step further. In the next section, we will examine Nestlé's liquidity and solvency indicators to see whether this higher leverage actually creates financial pressure for the company or not. So far, we observed a very interesting dynamic in Nestlé's capital structure. Total equity has been steadily declining, while net debt and therefore the gearing ratio has been increasing over time. Naturally, this raises an important question. What is actually driving this evolution? Is Nestlé becoming more leveraged simply because it needs more debt to finance its operations? Or is something else happening behind the scene? To understand this, we need to take a closer look at Nestlé's shareholder return strategy, and more specifically at the company's share buyback program. But before we analyze Nestlé's buyback activity in detail, let's take a quick moment to understand how share buybacks actually work and why companies use them. Here is a short explanation of the share buyback mechanism, and this mechanism is one of the most powerful and sometimes controversial tools in corporate finance. Companies often face a choice with their profits: either reinvest in the business, pay dividends, or buy back shares. A share buyback happens when a company purchases its own shares from shareholders in the open market. The effect? These shares are then taken out of circulation, which means fewer shares available in the market. The strategy behind this is simple. Return value to shareholders, show confidence in the company's strength, boost earnings per share since profits are divided among fewer shares, improve return on equity by reducing total equity, signal to investors that management believes the shares are undervalued. For shareholders who stay invested, buybacks often mean their slice of the pie gets bigger without them doing anything. Now let's define a key concept: treasury shares. When a company buys back shares, these shares go into a special category called treasury shares. They appear in the equity section of the balance sheet as a negative line, known as a contra-equity account. For example, when Nestlé repurchases its own shares, they are recorded under treasury shares. In 2022, this line reached 9.3 billion francs, directly reducing the company's total equity. Treasury shares don't receive dividends and don't carry voting rights. They are excluded from the number of outstanding shares used to calculate earnings per share or dividends, but they still exist legally and can be reissued or cancelled later on. But Nestlé goes a step further. Instead of keeping shares in treasury, Nestlé has a clear strategy. It cancels them. When shares are cancelled, they are permanently retired, meaning they are removed from the company's books and share capital, not just from market circulation. Share capital decreases by the nominal value of the cancelled shares. This is not symbolic. It's a consistent strategy. Nestlé uses buybacks not as temporary parking, but as a long-term way to shrink the share base. This has a few accounting effects. Share capital decreases by the nominal value of the cancelled shares. The treasury shares account is cleared. The difference between what the company paid and the nominal value is taken from reserves or retained earnings. The result is simple but powerful. Fewer shares exist permanently, which means each remaining share represents a larger ownership stake in the company. Some companies like Nestlé apply this consistently, using buybacks not as a temporary parking, but as a long-term strategy to shrink the share base and enhance shareholder value. Now that we understand how share buybacks work, let's see how Nestlé has been using this strategy in practice. In recent years, Nestlé has been actively repurchasing its own shares, and this has a direct impact on both equity levels and the number of shares outstanding. So on this page, we will explore how share buybacks affect Nestlé's balance sheet, its capital structure, and ultimately, in the next video, how the company returns value to its shareholders. We will start by looking at the evolution of Nestlé's total equity and its components, including treasury shares. In this chart, we can break down total equity into its main components, including share capital, retained earnings, and treasury shares. And here we can already see something interesting. The impact of treasury shares, which represent the share that Nestlé has repurchased from the market. This buyback gradually reduces the company's equity base, which helps explain the declining equity trend we observed earlier. Another way to see the impact of Nestlé's share buyback strategy is by looking at the number of shares outstanding. And the trend here is very clear. Over the period, the number of shares outstanding steadily declines, from just over 3 billion shares in 2018 to around 2.5 billion shares in 2024. This means that Nestlé has been consistently reducing the number of shares available in the market through its buyback programs. But there is another important financial effect behind this trend. When a company reduces its shares outstanding, each remaining share represents a larger ownership stake in the business. As a result, key metrics such as earnings per share, free cash flow per share, and dividend per share can improve, even if the company's overall profit remains unchanged. In other words, share buybacks allow the company to return cash to shareholders while simultaneously increasing the value attributed to each remaining share. This is one of the reasons why many large corporations, including Nestlé, actively use share buybacks as part of their capital allocation strategy. Of course, the real value creation depends on whether shares are repurchased at attractive valuations. Now let's look at the scale of these buybacks and how many shares Nestlé has actually repurchased and cancelled over time. This chart combines the value of share buybacks with the number of shares repurchased and the number of shares cancelled. And here we can clearly see that Nestlé is not simply buying back shares from the market. A significant portion of these shares is subsequently cancelled, permanently reducing the company's share count. This is an important distinction because cancelled shares no longer exist. As a result, the ownership stake of the remaining shareholders increases over time. Throughout the period, Nestlé consistently repurchased and cancelled tens of millions of shares each year, with some of the largest buyback programs occurring in 2019 and 2022, when the share repurchases exceeded 9 and 10 billion Swiss francs respectively. Overall, this chart confirms that Nestlé's buyback program is not a one-off initiative. It's a long-term capital allocation tool designed to enhance shareholder value and gradually reduce the number of shares outstanding. Now, let's take a closer look at how Nestlé returns value to shareholders. As we can see, the company uses two complementary mechanisms: dividends and share buybacks. Dividends provide a regular and predictable cash return to investors, while share buybacks offer a more flexible way of distributing excess capital. Throughout the period, dividends remain relatively stable, fluctuating around 7 to 8 billion per year, which reflects Nestlé's long-standing commitment to rewarding shareholders consistently. Share buybacks, however, are more dynamic. While they generally range between 5 and 10 billion, there are years where buybacks become even more significant than dividends. For example, in 2019 and again in 2022, Nestlé allocated more cash to share buybacks than to dividend payments, highlighting the strategic importance of this tool within the shareholder return policy. An interesting example can be seen following the L'Oréal transaction. In 2021, Nestlé sold part of its stake in L'Oréal, generating a substantial cash inflow of approximately 9 billion francs. Shortly afterward, in 2022, we see one of the largest buyback programs in the period, with more than 10 billion francs returned to shareholders through share repurchases. While we cannot say that the transaction directly funded the buybacks, the timing clearly illustrates how Nestlé actively uses its capital allocation flexibility to return excess cash to shareholders. Overall, this chart shows that returning capital to shareholders is not an occasional decision for Nestlé. It's a core component of the company's financial strategy. But the more interesting question is how much cash is Nestlé returning to shareholders in total, and how does that compare with the cash the business actually generates? To answer that, let's switch to the combined shareholders return view. This view combines dividends and share buybacks into a single measure, total shareholder returns. And immediately one pattern stands out. In several years, Nestlé returned more cash to shareholders than it generated in free cash flow. This is particularly visible during the period from 2019 to 2022, when free cash flow was declining, yet shareholders' return remained remarkably strong. In fact, even in 2022, the weakest year for free cash flow during the period, Nestlé continued to distribute substantial amount of cash through dividends and share buybacks. This highlights an important aspect of Nestlé's capital allocation philosophy. Management does not simply adjust shareholders' returns up and down based on short-term fluctuations in free cash flow. Instead, the company maintains a consistent commitment to returning capital to shareholders over time. So, what do these charts tell us? They tell us that Nestlé has been extremely consistent in one area: returning cash to shareholders. Through a combination of dividends and share buybacks, the company has distributed billions of francs year after year, even during periods when free cash flow weakened significantly. And this is where the story becomes interesting. because these shareholders' returns didn't come without consequences. Over the same period, we saw total equity steadily decline, net debt increase significantly, and gearing rise to its highest level of the period. In other words, Nestlé has chosen to prioritize shareholder returns over balance sheet expansion. Now, supporters of this strategy would argue that this is exactly what a mature cash-generative company should do. Why accumulate excess capital when it can be returned to shareholders? But critics might ask a different question. Has Nestlé become too aggressive? Has the company pushed shareholder distributions beyond what its cash generation can comfortably support? And more importantly, at what point does a shareholder-friendly strategy start becoming a financial risk? To answer that, we need to move beyond capital allocation and look directly at the company's financial resilience. Let's examine Nestlé's liquidity and solvency profile to see whether the balance sheet is showing any signs of pressure. So far, we have seen how Nestlé generates cash, allocates it, and structures its financing. Up to this point, the evidence points in two different directions. On one hand, Nestlé remains one of the strongest cash-generating companies in the consumer goods industry. On the other hand, debt is increasing, equity is shrinking, and shareholder distributions continue at an aggressive pace. So which story should investors believe? Let's test the balance sheet. To do that, we will examine four key indicators: net debt to EBITDA, interest coverage ratio, current ratio, and quick ratio. Let's start with net debt to EBITDA, one of the most widely used indicators to assess debt sustainability. This ratio compares the company's net debt to its operating earnings and essentially measures how many years of EBITDA would be required to repay the company's debt. Please note that values are currently displayed in millions. The unit can be changed using the filter on the left. Net debt to EBITDA assesses how many years it would take for the company to repay all its debt using its operating cash flow. It's a key indicator of financial strength and solvency, widely used by credit agencies and investors. In simple terms, if the company used all its operating profit to pay debt, how long would it take to be debt-free? If the ratio is lower than 1.5 times, very strong, debt easily repayable, conservative structure. The ratio between 1.5 to 3 times, comfortable, normal level for large corporates, manageable risk. The ratio higher than 3 times, weak, higher leverage. Watch for debt pressure or declining earnings. As we can see, this ratio has been gradually increasing over time. In 2018, Nestlé's net debt represented about 1.7 times EBITDA, which is generally considered a very comfortable level. However, as the company increased its debt while distributing significant cash to shareholders, this ratio rose steadily. By 2022, it reached around 2.85, and in 2024 it climbed slightly above 3 times EBITDA, which is the highest level in the period. At first glance, this seems to support the concern we raised earlier. After all, a ratio above 3 times EBITDA is significantly higher than where Nestlé started, and it reflects the combination of increasing debt and continuous shareholder distribution that we observed throughout the financing strategy analysis. But this is where context becomes important. For many businesses, a ratio above 3 times EBITDA could start raising questions about leverage and debt sustainability. However, Nestlé is not a highly cyclical company. It operates in a sector characterized by relatively stable demand, predictable cash flows, and strong operating profitability. So, while the trend clearly shows that leverage has increased, the ratio does not yet suggest a balance sheet under stress. Instead, it points to a company that has deliberately chosen to operate with a higher level of leverage in order to support its capital allocation strategy. The key question is whether the company still has sufficient capacity to service this debt comfortably. And that's exactly what we will examine next through the interest coverage ratio. So the leverage is only one side of the equation. Having more debt doesn't automatically mean a company is under financial pressure. What really matters is whether the business can comfortably service that debt. And that's exactly what the interest coverage ratio helps us understand. The interest coverage ratio measures how many times the company's operating profit can cover its annual interest expenses. It shows the company's ability to meet its financial obligations from its normal operations, a key indicator of financial safety and solvency. It answers how many times can the company pay its interest from operating profit. Interest coverage ratio equals EBIT divided by interest expense. So, if the ratio is higher than 10, excellent ample buffer, minimal risk. From 4 to 10, healthy, comfortable coverage, normal for large firms. From 2 to 4, weak, possible concern if profits fall. And lower than 2, risks on earnings barely cover interest. High leverage risk. This metric compares EBIT to interest expenses and shows how many times the company's operating earnings can cover its financing costs. Before calculating the interest coverage ratio, it's important to clarify one methodological choice. Instead of using the total net financial expense, I use Nestlé's reported net financing cost of net financial debt, as disclosed in the notes to the financial statements. This isolates the financing costs directly related to the company's borrowings, excluding pension financing effects and other financial items, making the ratio more representative of Nestlé's ability to service its debt. Here we also see a declining trend. In 2018, Nestlé generated operating earnings that covered its interest expenses more than 22 times. Over the years, this ratio gradually declines, reaching around 10 times in 2024. So, over the period, Nestlé's interest coverage ratio gradually decreases, reflecting the higher debt levels and the increasing cost of financing. At first glance, this might appear concerning. After all, the company covers its interest expense far fewer times than it did at the beginning of the period. However, the key point is that despite this decline, Nestlé still maintains a very comfortable buffer. Even in 2024, operating earnings cover interest expenses by more than 10 times. In other words, while leverage has increased, the company continues to generate significant more operating earnings than required to service its debt. So once again, the evidence points in the same direction. Financial risk has increased compared to earlier years, but the balance sheet does not yet show signs of financial stress. The next question is whether this conclusion also holds when we look at short-term financial obligations. To answer that, let's move from solvency to liquidity and examine Nestlé's current ratio. So far, we have seen that while Nestlé's leverage has increased, the company continues to comfortably service its debt. But financial resilience isn't only long-term solvency. It's also about liquidity, the ability to meet short-term obligations as they come due. And that's where the current ratio comes in. This ratio compares current assets to current liabilities and provides an indication of the company's short-term financial flexibility. We can see that Nestlé's current ratio has fluctuated over the period, but the overall direction is slightly downward. After approaching 1 in some years, the ratio declines to around 0.82 in 2024, meaning that current liabilities exceed current assets. At first glance, this may seem surprising. Many investors are taught that a current ratio below 1 could indicate liquidity pressure. However, context matters. Nestlé operates one of the largest consumer goods businesses in the world, generating highly predictable cash inflows from its day-to-day operations. As a result, the company does not necessarily need to maintain a large amount of excess current assets on its balance sheet. So, while the ratio has weakened over time, it does not automatically signal a liquidity problem. What it does tell us is that Nestlé is operating with a relatively efficient and tightly managed working capital structure. But let's make the test even more demanding. The current ratio still includes inventories, which for a company like Nestlé represent a significant portion of current assets. So what happens if we exclude inventories and focus only on the most liquid asset available to meet short-term obligations? That's exactly what the quick ratio measures. And here we see a similar pattern. The ratio gradually declines over the period, falling from around 0.74 in 2018 to approximately 0.51 in 2024. At first glance, this could be interpreted as a sign of weakening liquidity. After all, it suggests that Nestlé does not hold enough highly liquid assets to fully cover its short-term liabilities at any given point in time. However, once again, context is critical. Nestlé is not a company that relies on large cash reserves sitting on its balance sheet. Instead, it operates a highly efficient business model that continuously generates cash through its day-to-day operations. In other words, Nestlé's liquidity strength comes less from holding excess liquid assets and more from its ability to consistently generate cash. So, while the quick ratio confirms that liquidity has become tighter over time, it does not point to a company facing immediate liquidity pressure. Taken together, the liquidity and solvency indicators tell a consistent story. Nestlé has clearly increased its leverage and reduced some of its financial flexibility in support of an aggressive shareholder return strategy. But despite this evolution, the company's strong cash generation, earnings power, and ability to service its obligations suggest that the balance sheet remains resilient rather than stressed. So, has Nestlé become more aggressive in its capital allocation? Absolutely. Throughout this analysis, we have seen a company that consistently generates strong cash flows while returning billions of Swiss francs to shareholders through dividends and share buybacks. As a result, equity has declined, debt has increased, and leverage ratios have moved noticeably higher over time. But has that translated into a level of financial risk that threatens the company's stability? Based on the evidence we have reviewed, the answer appears to be no. When we examined Nestlé's solvency and liquidity indicators, we found a company with higher leverage than in the past, but also a company that continues to generate sufficient earnings and cash flows to comfortably service its obligations. So the real story is not one of financial distress. It's a story of a mature cash-generative business consciously accepting a higher level of leverage in exchange for higher shareholder distributions. In other words, Nestlé appears to be deliberately operating with a more leveraged capital structure, not because it has to, but because management has chosen to prioritize shareholders' return over the accumulation of excess capital. Whether that strategy remains optimal in the future will ultimately depend on Nestlé's ability to continue generating the strong and resilient cash flows that have supported it so far. In the next video, we will continue the analysis by exploring how this financial structure translates into value creation for shareholders. In the next video, we move from financing strategy to value creation. We will analyze how Nestlé creates value for shareholders through key performance metrics such as return on capital employed and return on equity. We will break down return on capital employed into margin-driven and efficiency-driven components, evaluate the leverage effect within return on equity, and examine Nestlé's cost of capital through WACC. Finally, we will assess one of the most important value creation metrics used in corporate finance, economic value added, EVA, which evaluates whether the company generates returns above its cost of capital while accounting for business risk.